Hey everyone, welcome back to the channel. I'm so glad you're here with us today. Today, we're diving into a topic that's close to my wallet: mortgage loans getting denied in underwriting, even after you're pre-approved. It's a situation that can be incredibly frustrating and confusing. I know, you've busted your tail, saved up that down payment, got that pre-approval letter, and thought you were home free, right? Well, not so fast. There's more to the process than just getting that initial green light. That pre-approval isn't a guarantee. It's just the beginning of a more detailed review process. It's like getting to the checkout line and realizing you left your wallet at home. You think you're ready, but there's a crucial step missing. So, to save you from that same heartache and financial headache, I'm breaking down the top 10 reasons why loans get denied during underwriting, even after pre-approval. Stick around, because this information could be the key to securing your dream home without any last-minute surprises. By understanding these reasons, you'll be better prepared and can avoid common pitfalls. Let's get started. First up is a big one: changes in your employment. This can have a significant impact on your financial situation and your ability to secure a mortgage. Lenders want to see stability, consistency, proof that you can actually pay back the money they're lending you. They look for a steady income history and reliable employment. If you decide to quit your job after getting pre-approved, it can create complications. Switching to a lower-paying gig can also be problematic, or if you go from a salaried position to being your own boss, it can raise red flags for lenders. These changes can throw a wrench in the whole process, making it harder to get approved. They see your income changing and suddenly you're a bigger risk. Lenders may hesitate to approve your loan. So, unless absolutely necessary, try to hold off on making any major career changes until after you've closed on your new place. This will help ensure a smoother process and increase your chances of securing the home of your dreams. Remember, stability is key. Keeping your employment status consistent can make all the difference in getting that final approval. So, stay the course, and soon enough, you'll be celebrating in your new home. Next up is another major culprit: your debt-to-income ratio, or DTI for short. Lenders use this to figure out how much wiggle room you have in your budget for a mortgage payment. If you get pre-approved and then finance a new car or rack up credit card debt, it could be a red flag for lenders. So, until you're holding the keys to your new place, put those credit cards on ice and resist the urge to take on any new debt. Remember, keeping your DTI low is crucial for securing that mortgage approval. Stay disciplined and avoid new debts. Let's talk about credit scores, that magical 3-digit number that can make or break your financial dreams. Your credit score is a living, breathing thing, and it can change faster than you can say foreclosure. Late payments, maxing out your credit cards, even applying for a new store credit card can ding your score, making you look riskier in the eyes of lenders. So keep those payments coming in on time and resist the urge to open any new lines of credit. Stay vigilant and you'll be on your way to homeownership. Chapter 4. Inconsistent or unverified income. This one's for all the entrepreneurs, freelancers, and anyone else out there with income that's not a straight-up paycheck. Lenders love consistency, and when they see income that's all over the place, it can make them nervous. If you're self-employed or work on commission, you know the drill: income can be a bit of a roller coaster. So make sure you've got all your financial ducks in a row and be prepared to provide documentation that clearly shows your income history. It's crucial to have a solid paper trail to back up your earnings, especially if your income varies month to month. Tax returns, bank statements, and detailed records can help paint a clear picture for your lender. The more organized and transparent you are, the better your chances of getting that mortgage approved. Chapter 5. Insufficient cash reserves or savings. Lenders want to see that you're financially responsible and that you've got a cushion to fall back on if things get tough. Having enough cash on hand shows lenders that you're prepared for unexpected expenses. So, before you even think about applying for a mortgage, make sure you've got a healthy emergency fund in place. This not only helps you in emergencies, but also makes you a more attractive borrower to lenders. Chapter 6. Property appraisal issues. Before a lender hands over hundreds of thousands of dollars, they want to make sure the property is actually worth what you're paying for it. This is a crucial step in the home buying process, as it protects both the lender and the buyer from overpaying for a property. An appraiser will come in, size up your potential dream home, and give it a value based on comparable properties in the area. They will measure the dimensions, inspect the condition, and evaluate the overall market trends to provide an accurate assessment. If the appraisal comes back lower than your offer price, it could throw a wrench in the whole deal. This discrepancy can lead to significant stress and uncertainty for buyers, as it may affect their financing options. You might have to renegotiate with the seller, come up with more cash for a down payment, or worst-case scenario, walk away from the deal. It's essential to be prepared for these possibilities and have a plan in place to address any appraisal issues that may arise. The appraisal process involves a detailed inspection and comparison with similar properties. Appraisers take photos, discuss findings with colleagues, and enter data into their systems to ensure accuracy. It's wise to meet with your financial advisor and review the appraisal report thoroughly. Discuss your options with your real estate agent to understand the best course of action. With the right preparation and guidance, you can navigate appraisal issues successfully. Whether it means renegotiating, adjusting your finances, or finding a new property, staying informed and proactive is key to securing your dream home. Honesty is the best policy, especially when it comes to your finances and getting a mortgage. Lenders want to see the full picture of your financial situation, and that includes any financial obligations you might have. These obligations affect how much money you have available each month to make your mortgage payments. So, don't try to hide anything from your lender. Be upfront and honest about all your financial obligations. Transparency can help you avoid surprises and ensure a smoother process. This one might seem counterintuitive, but trust me on this. Lenders get suspicious when they see large, unexplained deposits in your account. They want to make sure that money isn't coming from some shady source or that you didn't take out a secret loan to beef up your down payment. Provide your lender with all the necessary paperwork to avoid any red flags and keep your mortgage approval on track. Remember, transparency is key. The more information you provide, the smoother the process will be. Stay proactive and communicate openly with your lender to ensure a successful mortgage approval. Details matter, especially when it comes to mortgage applications. Lenders are meticulous, and they're looking for any inconsistencies or discrepancies in your application. Even small errors can raise red flags and lead to delays or, worse, a denial. So before you submit that application, triple-check every single detail. Ensure all information is accurate and up to date to avoid any issues. Let's face it, life happens. Sometimes things go wrong and our credit takes a hit. But when you're trying to buy a house, those past financial hiccups can come back to haunt you. If you have any of these on your credit report, even if they happened after you were pre-approved, it's crucial to address them head-on. Take proactive steps to resolve these issues to improve your chances of loan approval. So, there you have it. 10 common reasons why mortgage loans get denied in underwriting, even after pre-approval. The key takeaway here is to be proactive, be honest, and stay organized. Avoid making any major financial changes after pre-approval, keep your finances squeaky clean, and stay in close communication with your lender. If you found this video helpful, hit that like button and subscribe to the channel for more real estate tips and tricks. Until next time, happy house hunting. Remember, patience and preparation are key to a successful mortgage approval process.